streams recorded and
Yeah,
available?
yeah, what I just said, yeah. What I'm going to do, two things. One is this will definitely be available in the teams. And two, when I'm done, what I like to do, because it's a big class and they're always going to be, teams is tricky. Sometimes people can't find the recordings. So what I like to do is I give it some time until the recording is download it, and I'll put it into my YouTube channel as a private YouTube. And then this way, the class could access it that way if they can't get into Teams. So either way, you get a chance to see it.
Okay, great. Thank you.
All right, so I'm Professor Strafacci. Welcome to class. Been teaching here at Rasmussen for a few years now. I think 2 or 3 years. I'm 60, gonna be 66 in a minute, and I spent most of my career on in finance. I grew up, obviously, you can hear from my voice, in the New York area, and grew up in a place called Dyker Heights in Brooklyn, which is, I don't know if you ever watched the show Blue Bloods, but it's like where they live. I know, if you ever watched the show, it's about a whole police family. And once every during, did anybody here ever see Blue Bloods? But
I
once,
have. It's one of my favorite shows.
there you go. So once every episode, they have dinner at their home, and that's basically where I come from. And I lived like 7 or 8 miles away from Wall Street too. So I was kind of fortunate that I kind of liked it. My dad was in construction business, but he pushed me towards school, and I went to a local school near me called Zavarian, which was right in Brooklyn, and it was very, very hard Catholic high school. One of the toughest, and played sports there, the whole thing, a long time ago, obviously. And you had to pick a language. I picked Italian. Nobody spoke it in my house. I mean, it came so long ago, but I took it, and took all your classes in the language except for math and science. So you did that for 2 years, and then and a you had to pass a state exam. They call it in New York. It's called a Regents exam. So if you pass that you had to pass the state exam in every class you took, which was really a headache, right? But the good news was once you did that, uh, and you took it for every class, like in back in the day, and they still have it. Back in the day, maybe in some schools you take it for 3 or 4 classes, but in Zavarian you had to take it for every class. The good news was um, once you were done with it, you're done. You basically, just want to call this out. Yeah, once you were done with it, you get a scholarship to college, which was really kind of cool. So at any rate, it was right here. So, and Dr. Fauci, his family owned a pharmacy which was right up the block from my house. So, long story short, why am I telling you this? Well, then the last 2 years, they finally relaxed those prerequisites, and you were allowed to take electives. And that's when I decided I wanted to take economics and finance because I really liked it. I was into it. I read the papers every day, and I used to be into the stock market and things like that. I found it fascinating. So when I did that, that gave me really a good start. And you could see Wall Street's right here, and I grew up here, so it's like 8 miles literally. So I mean, if you're driving it on a busy morning, it's a lot. It could take you an hour to get in, but you can imagine it's right on top of the city. So, long story short, that's how I got started. Went to St. John's University, got my degrees in accounting, economics, and finance, right up to my master's. And then when I was deciding to do something different, my career, happily married for 40 years, been with my wife 45 years. We have 3 sons. My oldest is an engineer. He's got a PhD in bridge design, and my middle guy's an attorney and an engineer. And my little guy, he's in finance. He works for the Securities and Exchange Commission. We I went back. Had a buddy of mine who was a senior guy on Wall Street, and one day I was to the radio. Your Carver, and he had gone into academia, so I went to sit with him, and he gave me a start. I started working at this Wagner College, which is a small Division One school in Staten Island, and he urged me to go back to school. And right over here, where Wall Street is, this Pace University is right up here. And so I went to Pace about 4 or 5 years ago, and I've completed all my work, passed my comprehensive exams, which is like hours and hours of math and all this other crazy stuff in finance. And I just completed, well, I put my final draft in of my dissertation. So hopefully I responded to all the questions from my committee. So I did go back and do it because I'm almost done. But at any rate, that's a little bit about me. Like I said, come from the New York area, and that's how I got involved in finance, and I love teaching. I teach here. I teach at Rutgers University, and do some teaching for the city of New York. So CUNY, the city of New York, has its own um, colleges. It's got city universities of New York. So I teach there at the Staten Island campus, which is a huge campus. A lot of, like, Staten Island's a very dense area, but the campus is vast. It's amazing. And of course, Rutgers is a huge school. So that's a little bit about me. And I've been teaching at Rasmussen for a while now and really like it. So anybody like tell me a little bit about themselves? Anything? Anybody?
I'm Charlene. I'm a 36-year-old mother of an almost 17-year-old. I'm double majoring in marketing and nursing, studying to become an LPN. This class is already kicking my butt, so I really need to pay attention closely.
Okay. Good, good. Nice to meet you. Where are you from, Charlene? I don't know if I saw that.
I'm from the Twin Cities. I was born in Massachusetts, but raised in the Twin Cities, Minnesota.
It's tremendous. All right. Anybody else?
Hi, my name is Motsaraya, but I go by Raya. I am 29 years old. Um, I am a returning student to Rasmussen College. I'm from Minnesota. What again? I was majoring in human services, and I decided I needed to change because I've been working in this field that I work in for the past 10 years, and I would like to own my own business very soon in the future. And I just had to change to like the management position because I've always been in the management field and all. So yeah, that's a little bit about me.
That's great. Great. Where you from?
I am originally from West Africa, Nigeria, but I live in Minnesota.
Well, I gotta tell you, that's interesting. When I got started, like I told you, my buddy was in teaching. However, we had friends when we were raising our boys here in New Jersey. There was at the school my kids went to, the headmaster called us one day and said, we got a couple coming in. They work for back then it was Lucent, part of AT&T. They said they're going to be moving from Chicago. They got reassigned because New Jersey's a big area for that stuff. We have Bell Labs and all that stuff here, and they're going to be moving here. And they have a son, and he's about your age, and we'd like for them to connect with a nice family. Well, we became great friends, and the son is like another son to me. He the my our friend, the wife, was originally from Barbados and moved to Brooklyn when she was a kid, went to Tufts, but he comes from Nigeria, and he moved here a long time ago and went to school at Purdue, and they got his PhD at University of Michigan. So after a while, they left the telecom industry, and he took over as a dean at a school, and he was a place called Strayer, and he's not retired now. He went actually, I think shuttles now between Texas because they moved to Texas and Nigeria because his sisters live there. So he is a guy who inspired me to pushed me to do this. He said that this would be a great next part of your life, and he was right. I really very very grateful to him. So yeah, I got a little bit of a connection there.
That's great.
Yeah, good guy, really good guy. Sam Gooding, really good man. All right. Anybody else? And his son lives in Brooklyn. His son moved back.
Hi.
Yes, Viviana.
Hi, my name is Viviana. I'm 36 years old and I'm a first year student at Rasmussen. My degree is going to be on human resources. I work for the United States Postal Service. So the goal is to keep moving up at my job and, get more knowledge. I live in Florida, but I'm from Puerto Rico. So English is my second language. So it's going to be a very challenging year, but I'm hopeful.
No, no, good. Great to have you by. God bless you. Yeah, Puerto Rico, beautiful place. Been there a number of times. Really nice place. Part of
Thank you.
America. You're a United States citizen.
Oh, yes, of course.
Yeah, but we just when my son when we laugh about it every once in a while because if you grew up in the New York area, you got to remember I'm gonna be 66. So back in the day, there weren't as many you didn't have as much different types of immigration, but Puerto Ricans were always a major part of New York City life,
Oh,
and
yes.
a major part. Like you had your Italians, you had black, you had your Jewish people, and everyone got along. That was the beauty of New York. But yeah, they was a big part of life, and actually my grandfather was very involved in New York City politics, and back then you can look this guy up, Herman Badillo. And Herman Badillo was like the leader, like he was like the voice. He ran for mayor a number of times, and a great guy, a great part of New York City. So if you get a chance, you could do some research on him. A
I
really
will.
good guy. But what people tend to forget is people tend to forget that Puerto Ricans are U.S. citizens. They think of it as some like one of the islands, but it's part of us. So
We
yeah,
are.
I've been there many times. My dad loved going to the El San Juan. He loved it when he was alive. So yeah, it's a great place. Nice to have you aboard.
Thank you so much.
Anybody else?
Hi, everyone. My name is Mercedes. Um, I'm a mother of two boys, and I have my 14-year-old sister that lives with me. We're from Chicago, Illinois. We lived in Florida for 10 years, so we're coming back to the cold, and it's nice. Um, yeah, it's actually really nice because we visited in Florida 2 weeks ago, and I forgot how hot it had been the past
Yeah,
10 years. So it was nice to come back home from the vacation. But yeah, that's a little bit about us.
great to meet you, Mercedes. And Chicago's a great place, great business center. Now, Chicago beef. You can't be in finance and not
My
do business in Chicago.
favorite.
I love it too. Actually, I had a guy. Well, I had to go to Chicago in my professional life, and yeah, we've been there on vacation when we did a baseball trip. But I had a guy who, we used the same people when you got off the airline, and he had a place in Cicero that he'd stop at because he knew we really wanted that Chicago beef. Good
Oh
stuff.
yeah, definitely. Not too far
Yeah.
from there. Very
No.
real good.
Okay, great. Anybody else? Anybody
Yeah, I'll go
else?
next. Hi guys, my name is Tan. I'm from Jacksonville, Florida, but I'm originally from Syracuse, New York. Um, I have three daughters. Oldest is actually going to college as well at University of North Florida. She's going to be studying dentistry. Middle is in middle school. Last year middle school. Youngest is last year of elementary school. I'm 40. I've been with my wife for 20 years, and I've been with my company for 14 years. I'm a senior agent, insurance agent, and my company teamed up with this university and told me to go back to school, and I'm taking full advantage of it. And this class is kicking my butt too, but it's fun and I'm learning a lot.
That's it. No, it's good. It's good. And great to meet you, Tan. Really good
Thank
to
you.
meet you. And it sounds like great. And I'm glad that Rasmussen has these partnerships. That really helps, and it kind of tailors the classes for you. So that's a good thing. That's one of the really good things about online learning. Anybody else? Anybody else? All right, so let's get started. Hopefully you saw my um videos. So any comments on that? Because those are really designed for you to have to really give you an overview of the accounting spreadsheets. Because I know it can be difficult if counting isn't like your first language, literally. But that's why we do it, right? That's why we put it together. So this is any questions, or hopefully I know you had to watch it. I made it a prerequisite. only because I know that those, with the interactive spreadsheet, that's going to give you a good view of what this is about. So I'm going to refer to that throughout our class. But any questions on that? Any questions on the videos? All right, so let's take a look at the elements of the financial statements to kind of review our videos. So basically, you know, accounting is not as difficult. Can tend to be confusing because of the nature of just making sure everything is in its proper place and has to balance out. But at the end of the day, if you break it down, it can, once you get the idea of how these statements work, they can tend to be self-explanatory. And again, if at any point in time you're starting to kind of find some, you know, you're wondering where did things go. First of all, you got the McGraw-Hill site, which I've used in other places, and it's great. And there's a lot of resources there. But secondly, you know, use my videos, you know, because that's, and the interactive spreadsheet, because that's going to allow you to go through the spreadsheets and see how everything flows through. So if you break it down, the accounting statements are, I would say, threefold, but really twofold. You got your income statement. That's how we calculate what a firm makes or loses. And no matter whether it's a small company in your hometown, you know, a local company with 100 employees, well, it could be even a sole proprietorship, or a company as vast as Coca-Cola or IBM. Essentially, it's the same thing. So the income statement allows us to see in actual time how much money we're making or losing. So what do I mean by actual time? Because sometimes we have to account. Sometimes, like for instance, use this as an example. Let's say I get an insurance bill in June, and I pay it for a year. I'm a company, and so I'm good for this year and next year, like that till next year. Well, obviously, I close my books in these. And I bought it for the next year. So only 6 months of that insurance policy, even though I prepaid it, is used. It goes to that fiscal year. So my accountants need to say that that portion is an expense. I can't write off the whole portion. And if I did, I'd be doing something wrong, because there's something called generally accepted accounting principles. And those principles are vast because they apply to every industry, but they basically tell you how the rules of the game. So if I were to write off the whole thing because I don't want to pay as much taxes, I'd be doing something wrong. I'd get in trouble. Only thing I'm allowed to do is write off the portion that I use this year. So that's one of the fundamental keys in accounting, that my income statement reflects everything that happened that year. Even if I signed a contract in June with a company, and let's say that I've been doing this business with this company forever, and they pay me on a monthly basis, or they pay me in total. And let's say I got a contract with a company, and for the next year they're paying me $1 million. They're paying my company $1 million to do services for them, whatever your company is. I can only count to 6 months. The rest has to become an accrual. These things have to be accrued. So when you do the income statement, your income expenses, and what I'm trying to say, have to be for that specific period, and your income revenues have to be for that specific period. Whether you got a bigger check or a smaller check, or whether you paid for something or you didn't pay for it yet, it has to be accounted for in the income statement. If you don't do that, you're doing something wrong. And that's where the income statement could get tricky. But that's one of the most important aspects of the income statement, is that you have to match revenues and expenses for that particular period. And anything that you prepaid, or that you're getting, that you get a bigger check than you earn because it's a longer contract, or even stuff that you haven't paid for yet, but that it's an expense that's coming. Like, say, for instance, you guaranteed your salespeople a commission, but you don't pay it till, like, say, March, but you close your year in December. You have to accrue that expense for 6 months. So before I go any further, does that make sense to everybody? So I'm trying to give you the key points here. Does that make sense? I need a little feedback. That's all. Just even if you give me any kind of feedback. Any questions on that, I should say.
No, I'm fine.
Okay, good. Now, another point while I'm at it, and if you watch my videos, you heard this. Another point I want to make about the income statements is particular expense item. One expense item is going to be depreciation. Depreciation and amortization are another thing that could get tricky. I mean, again, that's why I'm teaching the class, right? Because I know where things can get tricky. Now, what is depreciation? I'll start with that because that's the most common one. If you own a company and you build a building, or you buy trucks, or you buy personal computers, or whatever you do, those are called capital expenditures. And the reason why we call them capital expenditures is because we're spending that money. Hold on one second. We're spending that money to make money later, right? August 20th. Good. We're spending that money to make money in the future, right? So we spend that money to make money in the future, right? We're building a building. We're buying personal computers. We're buying trucks. We could, what the U.S. tax code allows me to do is write off that expenditure over so many months or years. It all depends. Like there's different, how long could you write it off? It depends on where you live, what your state and federal government mandates, but there are specific regulations. So for instance, if you started a business and opened it in a challenged area economically, well, you'd get to write it off quicker because the government's encouraging you to open businesses there and help the community, and they'll let you take the expenses sooner. And sometimes, or like I remember back in the day when we had the AIDS epidemic, if a pharmaceutical company went out and spent money on research and development to develop drugs to cure AIDS, they would let them write those off quicker because it was a pressing issue in this country and they wanted to get it cured. So they encourage companies economically to go ahead and make that work. I'm not even sure what they did with COVID, but I'd have to look that up. But at any rate, that's what depreciation is. It allows you to write off the expenses. And what do you mean by write off? Well, if I show less income on my income statement, I pay less taxes. It's like when you pay your mortgage. Even though your mortgage comes out every month, like whatever it is every month, at the end of the year, when you do your taxes, you're allowed to write off the interest and principal payments off your taxes. So essentially what you've done is you've reduced your tax liability. So the income statement is going to reflect that expense because it's going to reduce your taxable income. Because once you do your income statement, then that's how you pay taxes on it, right? Then you got that income, you report it to the government, you pay taxes on that income. So that's what that's going to allow you to do. But you never really laid the money out. In that particular case, you've already bought this. It's a non-cash expense. I'm going to say it again. You're allowed to write it down because the government allows it, but you really didn't have to put the money out. Now, why would the government allow? Because they know at one point you got to replace the trucks. They know at one point you got to replace the building. They know at one point you got to replace the PCs. And so it's a way to encourage businesses to invest in capital, hire people, build businesses, pay taxes. So, think about it. As a company keeps building, more and more people and succeeds, more and more people work there. The company makes money. It benefits the economy. People pay taxes. So it just does what we're supposed to be doing, which is to build up our gross domestic product, right? I'm an economics professor. So bottom line is the depreciation is a non-cash expense. So that hopefully that makes sense to you. But when I do the statement of cash flows, that's different. Because the statement of cash flows tells me how much cash did I actually use, which is an important number for the people using the financial statements. Because even though I wrote it off, I didn't really spend the money. So I have to add that back to make the cash flows even. So I could see the actual cash that I spent that year. And we're going to talk about that in a minute. But does that make sense to everybody? Because I'm giving you the highlights of what's most important to understand the income statement. And again, watch my video. But and I'm sure McGraw-Hill covers it too because I've looked through the classroom. So any questions on that? Any questions? You guys hear me? Hello?
No question from
Okay, good. So try to remember that. And if you don't, watch the video again, or watch my videos, okay? Now, the statement of retained earnings is pretty simple, and you see that on my interactive spreadsheet. All the statement of retained earnings is really doing is it's taking whatever you made that year in cash. Now, remember, if you adjusted for depreciation and everything else, you're gonna have a cash balance at the end, right? You're gonna have cash that you made if you're successful. You could do two things with that money. You can either pay it out in dividends, which is a return of because what is it? Companies can only be financed with either debt or equity. So you pay your debt, like you would pay your debt even at home. You pay your interest on your debt, your mortgage, credit cards, whatever, car debt. And then you have money that you made. What could you do with that money? Well, you can return it to your shareholders, who were the investors, because they were the people who became your partners, and that becomes a dividend expense. But secondly, now you're left with cash. And if you put it back in the firm to build up your business again, which is what you're supposed to do, if you want to build your business, that becomes retained earnings. So the statement of retained earnings is nothing more than what you did with the money you made, the actual cash that you made. Now, the balance sheet's an important number. Balance sheet is the what you're worth. So one of the most important things you want to remember about your balance sheet is it's comprised of three items: assets, liabilities, and equity. And those three things are an identity. So you may want to write this down. So assets are everything you own, unencumbered. And it starts with the most liquid assets, which is cash or inventories, things you could turn into cash as soon as possible. And it keeps going down the sheet until you get the long-term assets, like buildings and grounds and buildings and trucks and things like that. So those are the assets. Those are the things you own. If you want to think of it in terms of your own personal balance sheet, and everyone could do this, you could say, well, there's the cash you have in the bank. That's an asset. There's any short-term securities or savings accounts or CDs. That's pretty short. That's an asset. Then you can have your cars, right? That could be an asset. That's an asset. Then you have your house. That's an asset. And these things are all assets. And then you can have a 401k. That's an asset. And then on the liability side, it's what you owe. So you got what you own as the assets, and now what you owe against it. So a mortgage would be on the long-term liability. Credit cards would be a short-term liability. These are all, you rank them from most of the stuff you need to pay quickly to stuff you pay longer. And you have an auto loan. That's a liability. So if you think about it, once I take what I own, let's say it's $1 million, and then I take what I owe, which are my mortgages and my car loans, and let's say that's $400,000. The identity means that once I subtract my liability from my assets, it is what I'm worth, which is your equity. So in that case, you would be worth $600,000. And once I know two of the numbers, I can back into the third. That's an important thing. That's why we call it an identity. You'll find out in accounting, a lot of stuff just balances out. So if I know, like, for instance, that I have 500,000 in assets and 300,000 in equity, well, then I know that I have 200,000 in liability. I always have to make that work. Assets minus liability equals equity. And that's an important part of the balance sheet. And then finally, we have the cash flow statement. So the key elements, so when we go through the income statement, the key elements are any revenues you have, any expenses that go exactly to the revenues you're generating in that specific time, and then what you made that year. That's the key. And now that you understand the different adjustments you need to make, I'm hoping that it becomes a little clearer for you. And one of the exercises in this week's work is you're going to have to identify which things go on your income statement and what go into your balance sheet. Because once you know what you made, then that's going to go into your income statement as new cash, right? And you're going to account for what you own and what you owe, and that's going to be what you're that's a statement, a snapshot of what your company is worth. So what your income statement tells me is what did I make in a specific period. What the balance sheet shows me, it's a snapshot of what my company's worth in a specific period. And then so we talked about your statement of retained earnings, which is where you started that year with retained earnings, how much cash you had. Then you take how much money you made after all your expenses. Then what you paid out in dividends, and then the rest goes back into retained earnings. Pretty simple. Retained earnings, not hard to deal with. Balance sheet, I just went over. You have your assets, you have your liabilities, and you have your equity. That's why I went over that whole thing. And then finally, your cash flow statement, you have to adjust for those things like depreciation and money you spend financing the company. And again, I'm going to keep going, but this is all stuff that I went over in those videos. So hopefully that made some degree of sense. Any questions on this?
I don't have any questions.
Excellent. Thank you so much for that. And anybody has a question, just stop me. Just talk it to the mic. Don't be shy. This is not about being shy. This is about learning. So I have no problem with you stopping me or saying, Professor, stop there for a minute. I prefer that because I don't want to just keep talking and you. Yes, please.
Wait, I don't have a question, but I did send you a message earlier this morning about sending the Excel spreadsheet. If you can, please.
Oh, okay. Wait, I think I have it here. Did you
Okay.
check my messages? They should be in there. Check my announcement. I attached
All
it
right.
to my announcement. Yeah, just check it because I know I'll send it again, but I know I sent it. I just want to make sure I sent it.
Okay.
Just
Thank you so
check
much.
yeah, let me know if you could find it. All right, so preparing financial statements involves several key steps to provide a comprehensive view of the company's financial performances. Business events and transactions are recorded in journals. It always starts with a journal. So you have your bookkeepers who keep the journals and ledgers. That's how a company runs, right? They have bookkeepers, accountants, right? These are people who every day as money's coming in, money's coming out, people are giving cash receipts, they're spending money on different things. They're recording those things in journals, okay, and ledgers they call them. But then eventually those things go into the statements. So you have to start somewhere. You get receipts. Like think about when you're running a business. Someone comes in, they do business with you. It shows up in your, every lot of stuff is done electronically. You pay vendors. That stuff gets recorded in ledgers and journals. All that stuff goes into ledgers and journals. And this way you have a track where you can track where everything comes from. Because think about what accounting does for us. It not only gives us a snapshot of what my company made or what it's worth, it also allows me to foot out and understand where all these numbers came from. So there's no illegality. And it's not always about being illegal too. It can also be that I just want to know, why did I spend this money? Who did I pay here? Think about it. You're running a big company. There's going to be a lot of people working for you. So if you're paying insurance, you have a whole division paying that insurance, you may want as the CEO, the CFO to say, bring that ledger in or get that information. I want to see who we're paying for this insurance to and what's the period and how much are we paying and blah, blah, blah. And someone's got to be able to produce that. And all that stuff is in journals and ledgers. And then, of course, there's also the legal part of it. You have audits. And every year, accounting firms have to give you a clean audit. And they'll go through these journals and ledgers to make sure there's no chicanery, to make sure that everything that's being spent is actually comes from the firm. Nobody's taking money. Nobody's paying for things they're not supposed to be paying for. All these things are checks and balances so that the books and records are clean and that anyone relying on the books and records of the firm can safely rely on the books and records of the firm. So you see here, when we talk about the income statement, you have revenue on this side, the left side, and then, and that's total revenue, right? So the income statement looks like this, and then you take out your expenses. Now, what you don't see here is depreciation, but that would be there. And once I have my revenue minus my expenses, there's my net income. Now, as a user of these balance sheet, of these income statements, and of course the ones like the one in our what we're going to be doing in this class on an assignment is you got to go to Target. Now you can go to Emergent. I think I called that up. You can go to Target. You can pull this number up anyway. You can go to Investor Relations. You go to Investor Relations. Go to Investor Relations. So that's one way you can get Target. That's our assignment this week. That's one way you can get the Target. They give you the price and they have annual reports, right? They want the 2021 annual report, right? That's one way to do it. And here it is. Let's do the digital. Let's see what that was. Okay, so there's the 2021 annual report. Now, you can also find anything you need through Mergent, which is a very good system that Rasmussen gives us. And what I did there is I searched for TGT, which is a symbol for Target. So you can get it that way. So I'm just giving you a little help with so Target, here's targetcorp.com. That's what you would find. Got to get the right thing. Okay, you know what happened? I was logged out for a while. I called it up again. All right, so let's just so to get in there, you could search for it either through the way I just did it here. You know what, as a matter of fact, let me do this. I'm going to do this for you guys. Bear with me. So I'm going to do it here, announcement. We're going to go into our announcements. I'm going to do two things. This way you know where to look. Okay, target 2021 annual report. And my interactive spreadsheet. All right, so we're going to do that right here. There you go, FYI. And let's get that information here for you. So the first thing is that first attachment. Save that. And the second one is going to be interactive. There we go. So there you go. I'm putting that in the announcements. Everyone see that? Does everyone see that where I put it? You guys hear me?
Yeah, we're good. It's in there.
I see it.
All right, good. And here's what I'm going to do. I'm going to do this too. We're going to go to content. We'll go to week 2. And we're going to create that. And do it as a, I guess as a folder. So screw that up. Hold on. Bear with me. So now you know where to find all this stuff. Go back here. We'll create a document. That I'll upload the file. There you go. There's your target. That should show up here. And where would you, and you'll see that when you go here to the assignment, they're going to say, find the 2021 report. Or you could use merge it and do it that way. But now you have it, so you don't even have to do that. Okay? And then you're going to do your report based on the information I'm giving you. All right, so now you got that. Now that's your income statement. Now you want to look at your statement of retained earnings. Now notice that you had beginning common stock and any stock issued. Then you had ending common stock. And now what you do is you add your income, which was right here. Take away anything you paid out in dividends. Remember, the two things you can do is pay dividends or retain it. And your ending retained earnings is going to be $13,000. You added it to your equity, which was, where does your, when you put money back in the firm, it becomes part of what you're worth. So we count for it in equity. So once I know what my equity is, then I put my retained earnings back, and my company is worth more now because I paid out some of my income as dividends, and that just giving my investors back some money. And then the rest adds to what I'm worth. And so now my new equity is $17,000. So you can start to see the good news about, and you could download these, by the way, but now you got enough information. The good news about accounting is it has to balance out. Does everyone see that? So really, if you want to learn from here is, I know what I made that year, 15,000. right? I know that I paid out dividends, the rest increases my net worth. Any questions?
Not
Any
for
questions?
me.
Good. Now, finally, you have the very good. Now you got your balance sheet, and I went over this. Now you see that on the left side, when you're staring at it, is going to be your assets, and on the right side is always going to be your liabilities and what you're worth. So notice we have cash, accounts receivable. That's money we lent to customers that they're going to pay us in revenue. Now, we don't want to call that cash yet because it's not cash. When they pay us, it'll go into cash. But we want to account for it because if our business is an ongoing concern and these are all good customers, even though we gave them credit to buy our services or our goods, it's going to be part of our income and it's something that adds to our value. So we account for it separately than cash because it's not cash yet, just in case someone doesn't pay us. And that's a whole other part of accounting. If you kept studying accounting and you really want to make this a career, then one of the classes you would take is called cost accounting. And that's where you start to understand, when do I account for money that I lent out? How do I account for money that I lent out? What happens if someone's late in paying me? Well, they have something called aging schedules where I could say, well, all these guys have been paying me, so I'm not going to diminish that. But there's one customer that's 90 days late. I might have to reduce this. You don't need to get that deep into it here, but it's not just as simple as putting your accounts receivable in there and waiting to get paid. You also have to account for the fact that people may be late, so you want to take care of that. And then you got your supplies, which are things you bought to run the firm. That's stuff that you're worth. You're just using it to make more money. Now, remember I told you about the prepaid insurance. I paid for it. I didn't use it yet. It becomes an asset. And then I got the land that I own. So these all become assets, right? Now, the liabilities, which really should be showing up on this side, but at any rate, once I add that up, I have my assets. They're trying to illustrate something for you. Normally speaking, your assets would be on one side, your liabilities would be here. So I'm not in love with the way they did this because it's not officially how you would see it. Accounts payable will be here. That's what I owed out. So if I have vendors that were giving me products or raw materials, I didn't pay them yet, I have to count that as money I owe. And then anything I didn't earn yet have to be counted here. And that would be my liability. And notice when I take this minus this, 24 minus 7 is going to be what? 17. Well, some of it is going to be stock and the rest is going to be retained earnings. And notice assets minus liability equals assets minus liability and equity. Assets minus liabilities equal what I'm worth. Finally, I have my cash flows. That's how I reconcile my accounting statement. Again, this is one set of the statements I would spend some time watching my video again because I do a little better job explaining. Well, not I do a better job. I think I do a good job explaining it. So here you got your cash flows from operating, and that actually is what you made operating. You don't count that depreciation number. And then this is what I invested. So if I spent money, say buying PCs or trucks or anything like that, that has to be money I took out of my cash, right? So I got cash that I made, cash that I spent to build new things. So this is how you reconcile your cash. Because the cash I spent to build new things are not going to necessarily show up on my income statement, but they are there. I paid for them. I built my firm up. That has to come out of my cash. I took it out of my pocket. Then I got my cash flows from financing. So let's say, for instance, I had a $2 million loan and I paid it. Well, that would be money I spent, but I got the debt off my books. But then if I replaced it with a new loan, I have to add that as new cash. So let's say for you personally, you had a credit card that was $20,000. And let's say, for instance, you saved your money and you made a payment, you paid it off. But in the same time, you took on a new $5,000 credit card because you want to have some extra cash. You would basically say, I spent $20,000, that's a negative to cash, but then I took in a positive $5,000 because I got new credit. And so your net would be 15. And that's what you do in finance. Well, if I take on new debt, that would be, if I take it on, if I borrow more money, that's new cash that comes into my account. If I pay off old debt, that's old cash. That has to be accounted for, and you net that out. And when you net all these things out, you're going to have your cash balance. And then add it to where you started, and that's going to be your ending cash balance. So all you're doing in this statement of cash flows is basically reconciling all your cash. So this way, you know, I had this much cash to start, I have this much cash to end, and this is where all the money went. Any questions? Any
No.
questions? Good, good. It's again, not the hardest thing, but you got to put, you got to just make sure that you just take your time with it and understand that everything has to balance out. If things aren't balancing out, you got a problem. You got to find, if all of a sudden you have $1 million in assets and 500,000 liability, but you only have 300,000 you can account for in equity, you got a problem because it's not balancing out. You got $1 million minus 500, you should have 500 in equity. If you only have 300, what happened to the other 200? At that point, your accountants have to go in and figure. Now, that's a dramatic example, but sometimes if everything doesn't balance out, you just have to go figure it out. Sometimes, and believe it or not, when you take accounting, they have all like different methods to catch these things. Like maybe you transpose the number. Instead of counting it as 68,000, you made it 86,000. That happens. These things happen. But there are ways you can catch these errors. But you have to catch the errors. You cannot close your books if you're not balancing out. The accountants won't allow it. And in most firms, they have two sets of auditors. Auditors are the people who come in and check your balances. So in one place, you have the internal auditors. Those are people who work for you. And that's fine because they're keeping an eye on the books for you. But then you have to bring in an outside auditor to get the official imprimatur or say these books are good. Because if they give you a qualified opinion, you're going to have a problem. And if a company that has stock out there gets a qualified opinion, they're going to kill that stock because people are going to say, I can't rely on these numbers anymore. So the one thing you don't want to have is any kind of qualified opinion. And the only way you're going to get those things is you're not following GAAP, generally accepted accounting principles. So income statement, here's one now. Now, the first income statement I did show you, that was for a service business, like a law firm or a medical firm. Here, this is for a merchandising business where we're actually selling stuff. So when we're actually selling stuff, we have our revenue just like we had in the service business, but you have to reduce the cost of goods sold. That's an important thing because you want to know how much money you're making on what you're buying. Then you take away your expenses, and then any non-operating items go in. That wasn't part of how you made money. So you can actually identify the expenses you're using to make money. And that's it. That's it. And if again, a lot of that is in my interactive spreadsheet, right? And in my videos. So you want to, when you do the assignment, now you have the target stuff. You don't have to go searching for it. Although Mergent is a great thing that we give you here at Rasmussen. So if you have stocks in your portfolio or any of that stuff you want to look at, use Mergent. I mean, it's tremendous. Very, very good system. And here it is. That's frequently asked questions. Yeah, they actually tell you how to use it. Okay, so it's really a good thing, Like let's go back to Target. So I know it helps to know the symbol when you're looking for something. And so you see Target, there's your business description, there's where it's a very good system. I mean, it's well worth it. So if you want to research companies, or maybe you're going on an interview for a company, it gives you all your ratios, gives you return on equity, gives you revenues and expenses, gives you PEs, which we'll be talking more about as we move along. And then it gives you any news. I don't see anything there. And then your financials, which is what we've been talking about. There's your income statement. There you go, right back to that 2021. So this might be a better way for you to do this project. Because everything is just kind of laid out for you. There's your balance sheet. I would use this. I would make it easy for me. But, I gave you the statement anyway, if you want to look at how both flow together. They're the same information. They're getting it from the statements. And there's your ratios. So this is great for when you're doing anything for our class. Then you have an analysis. All your ratios are here. It's really good. So, and there's filings, there's your executives, ownership, sustainability, any reports. All here. Okay, so make use of it. You know, the school gives it to you for a reason. And what else? There is a kind of cool, besides the stuff you're doing for McGraw-Hill, and McGraw-Hill is relatively new. This is about a woman who's preparing. She started a company and her dad is helping her. So you'd say salaries payable. Salaries payable is something I owe later. So that'd be balance sheet item. And it would be a liability. Fees earned would be, let's see, what would it be? Income statement item. And it would be revenues. Accounts payable is money I owe, so that would also be a balance sheet item. And it would be I would also owe that money. So it would be a liability. Common stock would be on my balance sheet. That would be shareholders' equity. All right, so that's how you do that. And then you could, I'm not going to do the rest of it for you, but that's a good way for you to really learn and enforce what you're learning here, where things go. And you'll notice when you go to the assignments from McGraw-Hill, which is really a good system. I'm not just cheerleading, it really is, because a lot of accounting is going to be repetitive until you get it. Accounting is not extremely difficult, but you got to know what you're looking at. So notice that you got to pick the one that's right. Now I'm also showing you, that I got the answers here, but okay. And then you'd go to the next question and notice the next question is going to be, this guy started a company. This is the following events. You got to show them how it flows through. Okay. Now going back. Always return to Blackboard, by the way, makes it easier. You can look at your video lecture. And that's yet another way for you to figure out what's going on. And you play it. Okay. So it's 10:54 now. The keyword, the live class keyword for this class, hold on a minute, is going to be asset. The keyword is asset, A-S-S-E-T. A-S-S-E-T, asset. There will be this recording available. I think, Kanea, could you help me? It just shows up as a recording, right? I know I've been doing this for a while, but I love double checking.
Yes, under the classroom.
There you go. So you could find it on the classroom, but I will download it into a YouTube video. So for people who have a little trouble finding it, and this can be challenging, we have it in another spot. That's it. Any questions? I hope you enjoyed the class. Any questions?
I'm good. Thank you so much. Great class.
Okay, great. All right, guys. I'll see you next week.
Thank you.
See you next Tuesday.
Thank you. Have a great day, everybody.
You too.